This is your July 2023 finance and real estate update for Metro Detroit and nationally. I'm Mike Brennan with the Brennan team right here at Metro Detroit, and if this is your first time on the channel and you want to learn everything about what it's like to work and eat and live and play right here at Metro Detroit, then be sure you tap the subscribe button and hit the bell. We get calls every day from people looking to move or relocate to Metro Detroit, and we absolutely love it. So if you're thinking about moving anywhere in Metro Detroit or Ann Arbor, be sure to give us a call, shoot us a text, send us an email, send us a carrier pigeon, however you want to get a hold of us. We've got your back when moving to Metro Detroit. All right, moving on. Let's start with the jobs report. Coming out at 209,000 was below expectation for the first time in a long time, but it's still a high number. At least that's what the Fed thinks. In addition to that, we had the inflation report drop the following week. Now it's down to 4% off the 9% it was last year, just 12 months ago, which is good news. However, it's not good enough. The Fed wanted a slower jobs report and a lower inflation rate. So what we're going to see this next quarter on a national level is interest rates are probably going to rise another quarter point. Probably not a half, but a quarter point. That's the prediction. Let's see if it happens next month. Next up, I want to talk about the stock market, which has been a bull market just on a rampage, on an absolute tear. Even though we're seeing the economy slow down, we're seeing the GDP slow down a little bit, what we are also seeing are the top companies' top line revenue continue to increase. I'm talking about Apple and Microsoft and Activision. Oh yeah, by the way, Activision and Microsoft, those guys are joining forces. So that's going from a $12 billion revenue and a $7 billion revenue, which will become a $19 billion revenue company, putting it in the top 5 of all companies. This is a great time to get into the stock market. I think this bull market is going to continue through next year because profits are still at an all-time high. Just look at Apple hitting $2 trillion, the first $2 trillion American company. Next up, we're going to talk about interest rates and the real estate market. Interest rates have officially hit 7%. 7%, guys, it is ginormous. Adjustable rate loans are still about a half point less, so there's definitely some wiggle room in those interest rates if you're looking to buy a home. And if you are looking to buy a home, now is the time, today is the day. Now I'll tell you why. The number of sales in Metro Detroit is down 22% year over year, but it may not be for the reason that most people think. A lot of people are thinking that the home sales are down because interest rates are so high and buyers do not want to get a 7% mortgage. Of course, nobody wants a 7% mortgage when just a year and a half ago we were looking at 2.5% or even 3% mortgages, but buyers got to move. The lower half of the millennial population and the top half of the Gen Z population, think 25 to 35, are now making their first time home purchases, putting a major squeeze on that price range right now. And I'm talking about here in Metro Detroit, it is darn near impossible to find an active property between, let's say, 100 and 350,000. That's happening. In the meantime, the major reason why home sales are down 22% and property values are up 3% year over year is because sellers are withholding their properties from the market. Sellers withholding their properties for one simple reason: they have a 3% interest rate. Over 80% of all loans are at or below 3.5%, and they don't want to give that up. So they're trying to stretch out the timeline. They're trying to stay longer in these properties. The average time in a property is now hit 14 years, which is the highest it's been in the last 50 years. That's huge, guys. By withholding all those properties off the market, we've seen year over year property values go up. Not by a lot. We're talking 2% roughly, depending on what part of Metro Detroit you're in. But still, it's an up number, not a down number, even with sales being down 22%. But there are two things coming down the pipe here that's going to change the real estate game as we know it here in Metro Detroit over the next 6 to 12 months. First one is adjustable rate mortgages. Roughly 1 in 8 mortgages in Metro Detroit is an adjustable mortgage. And when those mortgages come to adjustment time, which way are they going to go? They're going to go up. Why? Because the rate of the day is up. Now, most of those mortgages are going to be capped at either 1 or 2% per year that it can go up. A lot of them will be 2% year one and then 1% every year after that. But there are a lot of people that bought at their absolute max price when they did buy in 19, 20, 21. And even 22, which means when those rates start going up in those 18 and 19 loans, that subsequent payment hike, in addition to inflation on everything, is going to cause these guys to need to sell their property. Now, the good news is they've got a lot of equity, so I don't see foreclosures rising. In fact, foreclosures are at an almost all-time low, but what I do see is some sellers that will be getting on the market that otherwise wouldn't if their rates didn't adjust. The second thing I see is interest rates are probably going to start coming down early next year to mid next year, and as that happens, more buyers are going to jump into the market as affordability finally eases up. And yes, we're at the most unaffordable point in the last 25 years in U.S. real estate. And a lot of that, again, goes back to inflation rate, the cost of everything going up, the cost of properties going up, and the interest rate rising upwards of 7%. Now, when that happens, the fence sitters are going to get off the fence, try to quash their leases, and get into the real estate game, causing a huge demand, but again, not a ton of supply. Because when interest rates get down to 4.5% to 5.5%, which we will probably see by the end of next year or even 2025, we're still going to have a ton of people like myself, frankly, that are at a 2.5% or 3.5% interest rate that they're not going to want to give it up. Even though I would like to move, and I'm one of those people that are in that boat, I'm not going to move because my interest rate is so favorable and I've got such a low payment right now compared to what it would be even if I were just going to rebuy the same home. So my advice to home sellers and home buyers: if you're a home seller and you're considering moving up, now is the time, today is the day, because those properties are going to continue to get more expensive. 5% on your current home versus 5% on a home worth double. That 5% on the double home is literally double. It's more like 10% on your current home appreciation. Take advantage of that while you can, as long as you can afford it, and go in there eyes wide open that whatever interest rate you have on your current home, you're going to lose, and you're going to gain a 7% or a 6.5% rate on the new one. If you're a home buyer, now's the time, today is the day, because even though you're going to get a rate of 7%, 18 to 24 months from now, you're going to be able to refi that down into the lower rate that we're going to have. But what we can't do is go back in time, unwind the clock, and get you the home at today's price a year from today when it's up 5 or 10%. You're much better off buying now. Second and third reason for that is you're going to get the mortgage interest deduction write-off, which is a couple $1,000 every year, sometimes more depending on what price you're looking in. And you're also going to be paying down that property, so you're going to be gaining equity every month instead of building equity for your landlord. And again, if you're a home seller, last piece of advice, if you're a move down seller, my advice is stay where you are. This is the same conversation I'm having with my parents every single day. They've got an extremely good interest rate. Their taxes are low because they've owned the home for 20 years, and there is no advantage to moving down to a property even 50% less in value, because the taxes on that house, because of how long they've been in their house, would actually be higher. Their monthly bill would actually go up, not down, if they downsize. They're better off just staying put. My name is Mike Perna, local real estate agent here in Metro Detroit. This is your July 2023 financial and real estate update. Make it a great day.